we're right at that tipping point. And I'm not saying you can't find good deals out there, but I believe that they are so few and far between that the best thing you can do is just be patient.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. This is episode number 65. Weekly, we share interviews with real estate experts, passing on their experience and knowledge to our listeners. Thanks for joining us this week. My name is J. Darren Gross. We're so glad you're here. In just a minute, we're going to speak with Doug Marshall of Marshall Commercial Funding. Doug's been on the program a couple of times, and I've always enjoyed his input. He provides a longer view of the market instead of just the immediate market. Today, Doug takes us through the 6 immutable laws of investing. But before we do, if you're new to the show, we're glad you joined us. Welcome. And if you're returning, thanks so much for coming back. We'd like to invite you both to subscribe to the show. You can do that if you're on iTunes or Stitcher. Go ahead and in the search bar, go ahead and type in Commercial Real Estate Pro Network. And when you see our logo pop up, it's the headphones with CREPN between the ears. Go ahead and click subscribe. And this will ensure that you receive all of our episodes and you can listen anytime you choose, whether it's in the car, at the gym, or while you're out walking the dog. When you do subscribe, we'd love to hear from you. You can go ahead and leave a comment and let us know what you think. For those of you who don't know about me, I am a real estate investor. I'm also a commercial property insurance broker. I've been a commercial property insurance broker for 25 years. My primary clients are real estate professionals dealing in multifamily, retail, warehouse, office, and development. I'm also a real estate investor and have been for 20 years. And it's based on this that I'm always looking for more information about real estate so I can better support my clients and for information I can use in my own investing. And that's how Commercial Real Estate Pro Network and CREPN Radio came about. The easiest way to reach me is you can go to the contact button on commercialrealestatepronetwork.com and go ahead and send me a message there. I always like to give you a little insurance reference tip. And today I just want to touch on this. If you're hiring contractors, you want to make sure that they are insured. There was a recent event here. There was a gas explosion in Portland, Oregon, and there were some contractors digging, and they hit a gas line in a building filled with gas, and there was a spark, and the building is gone, and several of the neighboring buildings suffered some substantial damage. Fortunately, no one was killed, but the point that I wanted to bring to your attention. And also, I'm planning another episode here that'll show up here in a couple weeks, get into a little bit more depth about this. But I want to point out that this is the situation. If you're hiring contractors to do work, you want to make certain that they have insurance. More specifically, if you're doing any developing or any larger projects, I also recommend that you always get them to list you as an additional insured. And if you are engaged in any kind of a real estate transaction, or if you're engaging in a project and you'd like some input about the insurance respective to the what you're doing, give me a call. I'll be happy to help in any way I can. Give you a second viewpoint and do what we can to help you. Lastly, before we get on with the show, if you're on LinkedIn, please check out our group, Commercial Real Estate Pro Network. It's a great place to network with commercial real estate professionals. All right, let's get on with the show. All right, today we have Doug Marshall with Marshall Commercial Funding with us. Doug, how are you doing?
Hey, I'm doing great. You?
I'm good. I am absolutely fabulous. Loving this almost fall weather. It's a great time to be in the Northwest.
It certainly is.
But anyway, well, hey, I'm glad we're able to do this today. And for our listeners, if you don't mind, just reminding the listeners who you are and a little bit about Marshall Commercial Funding.
Yes, I am Doug Marshall. I'm a CCIM, and I provide financing for commercial real estate, most property types, but not exclusively, but primarily on apartments, office, retail, industrial, and mobile home parks.
All right. And as Doug and I have been known to do here recently, we've kind of struck up a somewhat regular conversation. Doug's a pretty, I'm going to say, a deep thinker when it comes to some of the topics that we've covered. I think a lot of people out there are caught up in doing the work and not always thinking about the big picture. And so today, I think unless you have a better way to refer to this, Doug, I'll let you speak. But I think that what we talked about and what we're going to talk about is taking a look at real estate investing in kind of a longer look. Does that sound?
Yeah, that's a good way of putting it. The title of today's talk is called The 6 Immutable Laws of Real Estate Investing. And I'd have to tell you that I didn't really come up with that title on my own. I read an article by James Montier, and James Montier is best known as the author of the little book of behavioral investing. And he recently wrote an article titled The 7 Immutable Laws of Investing. And in this article, he identifies 7 principles for sensible investing in the stock or bond markets. And I was intrigued by the title, so I read the article, and somewhere along the way, I realized that there are 6 of these 7 immutable laws could apply to investing in commercial real estate. So I thought, what the heck, maybe I should try and take a stab at writing an article with that title. So here goes, The 6 Immutable Laws of Real Estate Investing. And really, it was fashioned after Mr. Montier's article. But before I begin, I need to make sure our listeners understand what the word immutable means. It means unchangeable or unwavering. And so these laws are like the laws of physics or the law of gravity. They never change. So the first immutable law of real estate investing is always insist on a margin of safety. In other words, the goal is not to buy at fair market value, but to purchase with a margin of safety. And in our world of commercial real estate, this means finding properties that are underperforming the market. Maybe that the property is currently being poorly managed, or a property that needs to be renovated to justify higher rents. So the asking price placed on that property by the seller is a bargain in the eyes of the buyer because he has a plan to increase its value. Now, that's easy to say, but in today's market, it's really hard to do.
Yeah, no, the market's been combed through just a little bit. What's the low-hanging fruit's been picked, huh?
All of the low-hanging fruit is gone.
Yeah. I was just listening to somebody else this morning, and I think the conclusion is obviously the low-hanging fruit's been picked, but I think there's still supporting data, and the marketplace is always dynamic. I mean, there's always buyers and sellers. But I think trying to find that opportunity with big upside takes a little bit more digging, a little bit more looking, a little bit more thinking outside the box, or trying to find that exceptional value.
I would agree. I think it's very difficult these days, but it's out there, and it has to do more with an investor's creativity at being able to look at a property a little differently than the owner currently does. And because of that, they might be able to see an opportunity that's right in front of the owner, and he doesn't see it.
Right. No, agreed. What's our second immutable law?
Well, our second immutable law is this time is never different. The foremost dangerous words in investing are this time it's different. The dot-com bubble that occurred about 15 years ago is a perfect example. Investors were buying stock in companies that hadn't turned a profit on the expectation that they would be the next Google or Amazon.com. And stock prices soared, and even though it made no logical sense, the argument was that bandied about at that time was, this time it's different. The same was true of real estate before the Great Recession. How many believed that house prices could never go down? And in both examples, a speculative fever resulted in a bubble, causing stocks and house prices to plummet in value. And whenever someone starts saying this, it's time to get out of that particular investment. So this time it's different. Watch out.
Hey, I got a quick question, kind of a thought about that. You know, the market constantly has minor corrections. There's always, the stock, the price will run up or whatever, and there are people that are going to take their profits. Unlike the stock market that has a very liquid, fluid, in-out kind of thing, the housing market, or not just housing, but real estate's got kind of a slower ramp up, slower, or actually, I mean, I guess it could be sudden. I mean, clearly in 07, 08, it was rather sudden when the banks were no longer willing to lend. But I'm just kind of curious. I mean, some of the data I'm reading right now is talking about some of the pricing's cooling off. We've just talked about how some of the deals are a lot of the low-hanging fruit's already been picked. Are there historically minor corrections in real estate, or is it usually kind of a leveling and then a run-up, and then do you have any sense of that as far as a more significant kind of a correction?
You know, that's a good question. I really don't have a good understanding of how historically we've done it. I do know that, like right now, we're seeing nationally that values on commercial real estate, whether it's, apartments or office, retail, industrial, is beginning to level off. And I think that commercial real estate is a much more savvy way of investing than on the stocks and bond market, because they are really a lot more volatile and are more they're more what's the right word? They are more susceptible to the emotions of the market. And we don't see that as much in commercial real estate. Yes, it's there, but generally it's a numbers-based way of investing. And yes, the numbers can change overnight. They did in 2008 when outside forces caused valuations to plummet. But generally, it's a slower ramping up than maybe the stock market or the bond market.
Right.
Hopefully that answers your question.
No, I think we're good there. All right, so let's see, 1, 2. What's our third law here?
Our third law: be patient and wait for the fat pitch. I like this one. As Mr. Montier states in his article, patience is integral to any value-based approach. However, patience is in a rare supply. And in commercial real estate, there's a time to wait and there's a time to act. When things go bad, like what occurred after the Great Recession, the tendency is to dump our real estate holding as quickly as we can, when the prudent thing is to wait. Most investors suffer from an action bias, a desire to do something. But oftentimes the best thing to do is to stand at the plate and wait for the fat pitch.
Yeah, no, I've been on both sides of that thing. I've managed to buy at highs and buy at lows, and it's a world of difference if you're able to buy at the low.
Yes.
And, you're coming into equity. I mean, even when you're buying at the low and the market supports, that is the market price, because the market's low. If everything's cash flowing at that point and then the market takes off, whoa, Nelly, hang on. That's when it's really exciting, when you see the income really increase and the value run up. I think it is funny you mentioned the patience there. That's the I think, people, when they get into the marketplace, they want to act. I think I'm experiencing that right now with a client, and it's just they want to get in, they want to act, and so they're potentially making a decision that they might regret. Although one thing I have learned, even in some of the less favorable deals I've bought at the high of the market, if you're in for the long term, patience on the holding side of things can correct itself as well. So I would, obviously it's better, and I raise my hand to admit it's much better to be patient and buy the good deal. But if you can be patient even after you buy a deal, I think it works out.
Yes. I think right now we're right at that tipping point, and I'm not saying you can't find good deals out there, but I believe that they are so few and far between that the best thing you can do is just be patient and see what happens 6 months or a year down the road. You might have some money that you'd like to invest, but maybe it's not the prudent time right now. It could be. You just have to, go through the process of looking at a lot of different properties to figure that out. But it might be that we're at that tipping point, or it might be that we're still a year or two away from it. It's kind of hard to say. But the fourth immutable law, I think, kind of speaks to this in some respects, and that's be contrarian. Humans are prone to the herd instinct. When everyone is buying, they buy. And when everyone is selling, they sell. And in 2009, during the worst of the recession, a group of us put under contract an apartment that had been foreclosed on by the lender. And it took me 9 months to find a lender who would finance this property. And the rates and terms we got were very, very mediocre, but they were at least willing to finance the property. Nobody else was. And today, that property is by far my best investment. The value of that property has increased threefold from what we paid for it. We paid for it at $39,000 a unit. It's now worth about $120,000 a unit.
Wow.
And it's, the cash flow off that property is just, fantastic. But at the time that we bought the property, it was scary. Yeah, it really was. It was scary thinking about, should we buy this property? And, it took a lot of courage to do it because everybody else was not doing anything, or they were getting rid of their properties. And we decided, no, we wanted to try it. It took a lot of courage, and we did it. We really benefited by being able to not do what everybody else was doing at a particular time.
Let me ask you about that deal. So you said the valuation was about $39 a door. Was that based on, obviously net operating income? Was it based on the local cap rate, or was that based on, what was that based on? And what have you guys just been able to push the rents? Was it largely the rents were low, or did you recognize the rents being low then, or has it been? Tell us a little bit about how that picture changed.
Well, we recognized that the purchase price that was offered to us by the bank was even below market at that time. It was substantially below what it really was probably worth. It was probably worth $60 or $70 a door even back then, and we got it for $39. And then since that time, we were able to put some improvements in, upgrade the property a little bit, and the profile of the residents improved somewhat. But rents have gone up so much in the last 2 or 3 years, and cap rates have come down substantially, that the value now is as I say, threefold from what we originally purchased it for.
One quick question for you here, because I think this is kind of what, on this contrarian kind of mindset here. I think living in Portland and being very familiar with the Portland marketplace and a lot of the talk, or a lot of the market talk tends to talk about the primary markets, where the big swings, whether it be San Francisco, Seattle, Portland, I don't know is necessarily considered a primary market in all conversations, but I think that it's certainly gained national attention with the rent increases. But my question, I guess, where I'm going with this is, in the investment that you were talking about, was that in a primary market? Was it a secondary market? Was it a tertiary marketplace? Can you shed a little light on
the property was actually located in Vancouver.
Oh,
and,
wow.
And it was in a very modest neighborhood of Vancouver. And I would agree with you, most investors nationally do not think of Portland as a primary market. It just depends on who you're having a conversation with. Some people will think it's a secondary market. But Vancouver was kind of a little sleepy area within the Vancouver market itself. And so we were very fortunate to find it and to be able to buy it from the bank at a very reasonable price. And there's a saying in commercial real estate, which is so true: you make your money at the time of purchase. And if you can buy a property at a really good price, that's when you're going to be making your money in the future. It's not after most people are not smart enough to figure out how to increase the value of that property after they purchase it. Some can, but it's easier just to buy it at the right price.
Right. No, that's great. All right, let's keep moving here. What's our fifth law?
Fifth law is be leery of leverage, and you would think that a mortgage broker would not be talking about this, but no, I see this as really, really important. Is that you shouldn't, in many instances, there are owners that own property prior to the Great Recession that paid the ultimate price for leveraging their properties, and they lost them. And then there's those homeowners who use their homes as ATM machines, and they learned the hard way as well that they lost their homes because they over-leveraged their properties. Take advantage right now of all the blue light specials that lenders are offering today, and they are offering a lot. They're being very aggressive on their interest rates, their record low interest rates. Some are providing interest-only loans. Some are providing non-recourse financing. And there's other things as well. Take advantage of all those, but do not over-leverage your properties. When the real estate market turns again, and it's going to, it's just a matter of time, you want to have the peace of mind of knowing that the property is not over-leveraged. And as you know, a property that's underwater has the potential risk of losing it to the lender if they were to call the loan. One of the surprising things about what happened in 2009, that people lost their properties even though they paid their mortgage payment on time. Because when the loan came due, the lender said, yes, we'll be happy to refinance that property, but we're only going to put this much of a loan on it because the value has come down. And so the owners didn't have that additional equity that they could just take out from their bank and pay down the loan. And so they ended up giving the keys back to the lender.
Yeah, the days of 125% loan to value, right?
Yeah, that was especially on houses, but. The properties, commercial real estate properties, lost about 30% of their value in 2009. Apartments probably more like 10 to 15%, but all the other property types were about 30%. And so if you originally put a 70% loan on your property, value goes down 30%. You now are 100% financed. Loan comes due. And the lender's going to say, yeah, I'll be happy to provide you a loan at 65% of the new value. Oh, by the way, Mr. Barr, you need to give me an extra $1 million to be able to close on this new loan. And that happened. That happened on a regular basis. Even though the borrower had paid regularly on time with his mortgage payment for years. Never missed a payment, never was late. It had to do with that bullet coming due, that loan coming due, and they couldn't refinance it.
Right. What are you seeing as far as length of term right now that the market's willing to go on commercial financing? Are you getting 10-year loan commitments or?
10-year money is out there and probably is the most popular. And we also have 5 and 7-year fixed rate loans as well. So you can go one of those 3 all day long. Occasionally there are lenders that will go 15 or 20 years. But generally, if you go 15 or 20 years, you're going to have a significantly higher interest rate, and at some point it doesn't make sense.
Got it. All right. We've got 5 down. What is the 6th law?
The 6th law is never invest in something you don't understand. You know, this is just plain old common sense, but what I've learned over the years that common sense is not common. And you should never invest in a property type or location you don't fully understand. And now this can happen with real estate in 2 ways. One is, and I see this on a regular basis, investors that are new to real estate, they've been told how good an investment real estate has been, so they're excited to invest their life savings in the purchase of a property. And yes, real estate can be an excellent investment, has been for the last several years, but buying a property puts them at the mercy of their real estate advisors. And many times these advisors have a different agenda than the owner. But the owner, being new to real estate and not knowing the fundamentals of commercial real estate, are kind of unaware of this conflict of interest. So be careful with your selection of real estate advisors. I'm not saying that all real estate advisors are out there just to make a buck. But there are some that you just need to be very careful with. And then regardless, you should be asking a lot of questions about the property, get as much good advice as you can from your real estate advisors, whoever they might be. So that's one way. A newbie getting into the market and doesn't know what they're doing, they can get into trouble. And then the second thing that happens, and this is where I'm at, and a lot of investors are at, sometimes a real estate investor understands a particular property type or a location really well. They really have a good understanding of what they do. For example, they might own, let's say, apartments on the west side of Portland. But that doesn't mean they understand other property types like multi-tenanted retail located in southeast Portland. It doesn't mean they shouldn't purchase this property type or location, but it does mean they need to be careful and maybe lean on other real estate advisors that have the necessary experience to evaluate a particular real estate opportunity. So on the one hand, I'm telling you to watch out for your real estate advisors, and on the other hand, if you've been in the business long enough, you know the ones that are good, that are giving you good advice. And I would suggest that if you're going to be going into a new location, or you're going to go into a new property type that you're not normally investing in, then you need to lean on their experience as much as possible.
I like it. Kind of the step back a little bit and make sure you know what you're doing.
Yeah, it's a simple truth.
Yeah.
If you don't understand the investment concept, whatever it is, then you really shouldn't be investing in it. So you need to understand it as well as you can. So I personally believe you will avoid getting burned investing in commercial real estate as long as you follow these 6 immutable laws of real estate investing.
And just to summarize, it's always insist on a margin of safety. Time is never different, or this time is never different. Be patient and wait for the fat pitch. I love that one. That's tough. Be a contrarian. Don't always do what everybody else is doing. Be leery of leverage, and never invest in something you don't understand. I like it. All right, Doug. Well, hey, I appreciate you taking some time to go through this today. And why don't you give the listeners your contact information here so they can reach out to you if they'd like to learn more or get in touch with you? Yes.
I would encourage you to go to my website, which is www.marshall, my last name, MARSHALLCF, CharlieFrank.com. Or just call me. 503-614-1808.
Got it. And I'll put that in the show notes again. Doug, as always, appreciate it, and we'll be in touch soon.
Thank you very much. I enjoyed it.
I hope you enjoyed that. I have always enjoyed Doug's perspective. Enjoy getting his professional, longer view of the marketplace rather than just the immediate today view of what's going on. So, anyway, we know you're busy. We thank you for making time for us today, and we do appreciate you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.